Hello everyone, welcome back to my channel again. So moving on from the yesterday's video, as I promised, this video will be about the trades that I've put in today. I actually used the time just after the markets open at 3:30 local time here in Central Europe. Because I'm only trading options on stocks in the US stock market, namely the S&P 500 and the New York Stock Exchange and the Nasdaq. And so I took the chance to putting the trades in as soon as the markets open. There was a lot of decisions to do, but in the end, this is the layout of the trades that I did. I'm going to go through each and every one of them, and so in order also to update our basically our track record here. And so let's go for it. Moving on, starting by the calls that I put on the calls that I sold on American Airlines. Since I have 900 shares of this stock, I could use them as collateral for 9 short positions on calls on this stock. It was not an easy decision because, as you can see right here, I'm going to look for the stock here, and if I pull up the option chain of American Airlines, as you can see right here, for the weekly options, and keep in mind the average price that I bought these shares of American Airlines is around 13 euros and 72 cents, give or take. And so by the way the price is currently at around 10.56, there are no options available, no calls available to sell at around the strike price that I bought the shares. So and this strike price 11.5 and 11 is far too close to the current stock price, and the premiums are not that significant, so I decided to go to longer maturities. Even so, as you can see, the picture is not that much different in here on the options on the 2-week options. And so that is why I decided, as you can see right here, I decided to sell a call with a strike of 12 maturing on August the 16th. And why is that? Because that was the one that provides me a mix of, let's just say, a good balance between the strike price at which I would be obligated to sell the stock back, and at the same time it's far enough from the current stock price that for sure the likelihood of the call expiring worthless, which is currently 97%, so chances are I will keep the stock, and so I will continue to use it as a collateral to earn more premiums and try to offset the current unrealized loss that I have at the moment, which is significant. But nonetheless, my objective with this is to do my best to recoup the losses and eventually, of course, sell the stock, if not having a gain, or at least trying to have sort of a break even. It's a kind of sad prospect, but of course in this situation the market turned completely against us, and basically there was little you can do about it. These situations always happened, and you got to be prepared for it. And so basically I decided to sell 9 call options with a strike price on 12, maturing on August 16 here, in 3 weeks time. And so as you can see right here, I showed you the wrong call option. That was the one that I showed you was maturing in 2 weeks time. The one that I actually sold as a probability of profit, meaning expiring worthless, of 93%. So yeah, I'm fairly confident that this option will also expire worthless, meaning the stock price will not exceed $12 in about 3 weeks time. And so based on that, I will be able to keep the entire premium, keep the stocks, and then I will be able to sell more calls on this stock in order to try to recoup the current unrealized losses. Of course, if the option drops to, for example, 1 cent in a few days time, for sure I will buy back the call option and sell another 9 calls on the stock to keep getting more premiums out of it. All right. And so yeah, basically this is it. Let's just see the trade here, the trade record. So basically, yeah, I sold 9 calls. The price of the option was 4 cents. I actually had a credit in terms instead of a debit in terms of the fees that I paid, which was actually quite nice. So here I'm going to input the actual date in which the options on American Airlines expire, which is of course 16th of August, right? So in here it's a covered call. The strike was 12, and so never mind the collateral. This doesn't matter because this is a covered call. The stocks are actually the collateral, not actual funds. So this was 4 cents, and the actual credit was 9 cents, which was I have no idea why sometimes the fees are actually a credit in my account, but of course you can't complain about it. So that's actually a very good thing for us. So yeah, basically this is it. Moving on to the next trade. Yeah, basically let me see. It's probably better to go along with basically with this screen. I sold 4 call options on 4, all right, and I sold 2-week options, again basically for the same reason, because as you can imagine, with this current price, and keep in mind that I bought these 404 shares, 4 motor company shares at 13, and so at this moment for the weekly option there is no calls being sold or actually available to, there is no one buying call options for 1 week at 13. So and the premiums here are not that significant, and it would be far too close to the stock price. And also, and this is also an expectation of mine, or at least some sort of a hope that I have, I don't think the price will stay at this level for too long, and for me a rebound, it's more likely here than, for example, for the American Airlines stock. So I don't want to use these sort of strike prices here, which I believe are very, very close to the actual stock price. And so I decided to have a 2-week, to go for the 2-week options here. And as you can see, I decided to use the 12 strike price here. The actual probability of profit currently is 97%, and actually currently they are trading at 2 cents each, but I managed to sell them at 3 cents, which is actually €3 for each contract. And so basically this is what I decided to do. This is going to be a long road until I'm able to recoup from this loss, but again the expectation is that I will be able at some point to recoup the losses and be able to sell back the stock either with a gain or at least with a break even. So these calls expire at 9th of August, right? So the strike was also at 12, as you can see right here, and again 12. Once again, don't pay attention to the collateral because the collateral is actually the stock, and so I received 3 cents on each stock, so €3 per contract. And because each contract is for 100 stocks, and so this the fees that I got that I have to pay for were 2.8. So yeah, this is it. Moving on from here, again, perhaps it's just better for me to go ahead with the address the calls first because they are first in line here in the file. And so basically the other calls that I sold were 3 contracts on Estilo Day here, as you can see, because I have 300 stocks, and for me it makes sense to get some return out of those stocks. I bought these stocks at 100, and so I decided to use a call or to sell a call with a strike price of 103, because for me these are very high quality stocks. These are stocks that I want to keep for the long term, but of course it may happen that the stock will increase in price, and it's probable that the calls will be exercised, but nonetheless I decided to sell the calls with a strike price of 103. I will get the €3 capital gain on each stock if they are exercised, but nonetheless I think it's a fairly good trade to do. And so moving on to here, this was actually a weekly stock, so it expires next Friday. So here it is. Let me just right here. So the strike was 103, and the actual trade, I received in premiums 52 cents per each stock, so it's 52, and I paid in fees and commissions. Actually, I got a credit. I don't know why, don't ask me why, but I actually got a credit of 1. So let me see right here. So it's 105. All right, good. So this is done as well. So the other one that I sold was actually on HIMS, which is right here. Let me see. Yeah, it's right here. I decided to sell because, to give you some context, I had already ongoing 3 contracts. I had 3 contracts, 3 short calls on HIMS stock, and I could sell one more contract here. And actually these 100 stocks that had no option on, they were not being used as collateral. These 100 shares, I bought them at 22.5. So this other contract of HIMS, I decided, because the price was actually rather close to the strike of 23.5, I decided not to use the same strike, meaning promising to sell the stock at the same price that I bought them. I decided to use the same strike as the other ones, because 300 stocks I bought them at 23.5 and 100 I bought at 22.5. I decided just to try to sell all of them at 23.5. In that case I will have a capital gain on 100 of the shares that I have, and so I decided to use this contract here, this which has a probability of expiring worthless of around 85%. But nonetheless, I think it was a good option for me to do it. So this again is a weekly option. All right. The strike is 23.50, and let's see how it was, the conditions of the of the trade. So I received 35 cents. So 35, and the commission on it was 105. All right, so the commission actually was an actual commission. It was a payment that I had to do of 105. All right, so this is it for the covered calls that for the calls that I had to sell. Covered call is the actual trade. Covered calls meaning I sold a call using the stock that I have as collateral. All right. The other one, selling puts, is a cash covered put, meaning I am selling puts using cash as a collateral. And so let's move on to see the puts that I actually sold. As you can see, I sold several of them, but let's start by alphabetic order. And so let's just see this first one, the CMCSA. Or actually the Comcast Corporation. I sold 3 puts with a strike price of 39, and so this is a stock that I like a lot, and I believe it has good prospects. It's a high quality stock in my opinion, and so I decided to sell 3 puts on them, because in case the put is exercised by the put buyer, I will be obligated to buy the stock at 39 euros each. And so as you can see here, I bought them by with a premium of around 19. I believe that was the case. Yes, there it is. So let's add this to our scoreboard. Here the same thing. It's a weekly option, CMCSA. It was actually a cash covered put. The strike price was 39. I sold 3 contracts, so it used as a collateral 11,700 euros, and the premium on the contracts was 19 cents, and the fees were €1.35. All right. Got it. So the next one that I used, or the next put that I also sold, was also 3 puts on Estée Lauder stock. This is actually a different strategy, as you can see, because I have calls, and I sold puts and I sold calls on Estée Lauder. And just to give you a bit of an insight of how, let me just show you here. And so just to give you some insights of what kind of strategy I'm using in here. So if you have, never mind my drawing skills with the paint, this is not really that good, but just to prove a point here. So as you can see, I have sold puts on with a strike of 96, and I had sold calls with a strike of 103. And so what I did was a strategy which has this type of pattern here, as you can see. So here is 103, right? And here is 96. This, in the options terminology, is what we call as a short strangle, meaning I am hoping that the stock will remain between the values of 96 euros and 103, and so if that happens, I will maximize my profits. You see, because along this area, as long as the price remains between 96 and 103, I will maximize my profit. And so if the stock falls below 96, I will be forced to buy the stock at 96. And so if the stock falls far below 96, I will have an unrealized loss because I'm buying stocks at $96, which are valued much less than 96. And if it goes above 103, I will be forced to sell the stocks that I have. And of course, because the stocks are valued higher than 103 and I will be selling them at 103, I will be having an unrealized, also I will be losing because I'm selling something which is more valuable at a lower price. But for me, it's not that big of a deal because I can buy them later and I will get some money back with a capital gain. So it's not really an issue, but this is just a strategy just to show you that this is a strategy that profits on low volatility, meaning the price of the stock does not move that much, will stay in between these two prices, and so I will maximize the profit. Basically, the maximum profit here is the sum of the both premiums that I received, meaning the put and the call. All right, this side is the call and this side is the put. All right, and so I received premiums from both the call and the put, and if the price remains between 96 and 103, both options expire worthless and nothing happens, the contracts go away, and I keep the premiums of both the put and the call, meaning I maximize my return with the strategy. But this is just a side topic, just to give you a little bit more of a knowledge in terms of options. There are many other strategies, but this is something that I use as an example to you. And so just for you to know, this is puts on Estée Lauder. The strike of the put is 96. I also sold 3 contracts and now we're going to see for how much I sold those puts here down below. Yeah, actually the premium was 55 cents and I actually got another credit of 15 cents, which is always a good thing to have. So this is also good. Now moving on from here to the next one, always in alphabetical order, and yeah, basically this is the last put that I sold, which was puts on Pfizer, which is a pharmaceutical company. I'm also a believer that this stock has very good quality and it's good to hold for the long term. So I sold a put with a strike of 29.5, expiring also in a week's time. As I said before, for me, it's always I have always a preference of selling weekly options. All right, and so let's see the details of the trade. Yeah, this is it. So again, it's a weekly option. It's on Pfizer. It's a put. The strike price was 29.5. I think I sold 5 contracts. Let me see. So the put, yeah, because it's 3 here and 2 here, I believe, yeah, I believe there were 5 contracts. Exactly. So these are 5 contracts. And so here, 5 contracts. This is the collateral, 1470, 750, and just to confirm the price of both, let me see, 24. Yeah, because I did this trading on different times. This is 24 and this is 30, and so let's just do a simple calculation on the average price. I think this is the best way to deal with this kind of situation, which is not a problem per each. Before, yeah, all right, so 24 times 3 contracts plus so this is 72 and this is 60, right? And so wait, 60 plus 72, right, now divided by 5, yeah, this is what I was expecting, is 26.4. This is not a common situation, so I apologize for this. My mind just went blank for a few seconds, but yeah, this is it. So let's just see for how much is the commissions. In the commissions, of course, we are going to sum it all. So it's 135, 138. 135 plus 2 is 270, plus 3 cents is 273. So yeah, this is more normal. All right, just hide this, and yeah, basically this is it. Let's just save this, and yeah, this is our trades for the week. Actually, I did, as you can see, less trades than I usually do, but nonetheless, I feel that yeah, this was probably some of the best trades that I could do based on the current situation of the market. And yeah, basically we are going to wait until the end of the week how it pans out, and if there are some options which are very, very close to zero before the week, the end of the week, I will be selling them, and not selling them, buy them back, and resell more puts, so that we can continue to gather the premiums. Because as you can, this in here, the dynamic is a little bit different of what is usually done, because usually in the stock market you want to buy low, right, so that later you can sell high price at a high price, right? So you have, again, here the reasoning is reversed, because we are selling, all right, we are selling options, so the objective is to sell high, and then later on either let it expire, so, and then when it expires, most of the time it will expire worthless, so value is zero. Or if we can close the trade and realize the profit, so that we can sell more puts afterwards, we want to buy the options back at a low price. And so this is what I've been watching for over the next few days until the end of the week, to see if there are any trades that are currently live that can be closed profitably. And so the collateral, either cash or stocks, can be reused to sell more options and collect more premiums. But yeah, basically this is it for today. Let me know in the comment section below any questions that you have, any insights that you want to share about this. And as I mentioned in the previous video, I will be making another video over the weekend to show you how these trades panned out. And so, yeah, fingers crossed, and let's see what happens by the weekend. And yeah, enjoy the week and have a good one.